Welcome to Master Trader's Weekly Trade Review. I'm Dan Gibby, and in this review, I'm going to show you a bunch of examples that we did recently and show you the keys to trading high probability topping patterns and breakdowns, both trading stock and shorting bear call credit spreads. This is our technical approach to trading anything that moves: stocks, options, cryptocurrencies, futures, commodities, anything, it doesn't matter. We need a compelling price pattern on the time frame you're trading. Then we take that picture and we put it in the overall trend, support, resistance. Is it showing relative strength or weakness? What about multiple time frames? Any favorable volume characteristics to increase the bias of the setup? What are the broader markets doing? Market internals. Once you find that, you simply calculate position size per your trading plan and manage in between. So this is a proper breakout, but I'm going to talk, every slide in here is where we nailed the turn on the broader markets last week, and we're going to be talking about topping patterns. So the correct breakdown is you had an uptrend, now it broke its uptrend, converted to a sideways trend, which is relatively equal highs and lows, and then consolidated at support and broke down, or broke down and retraced and reversed at minor resistance. I'm going to show you different flavors of these. They were all over the place recently. And we use this word, the tell. It's like a poker term where you say, ha ha, I got you. Because topping patterns, believe it or not, are harder to trade than bottoming patterns, because it seems like fear gives it up quicker, and these tells jump out at us more on capitulation bottoming patterns, and when you're in a roaring bull market on an individual stock or sector, then they don't give it up as easy. So let's begin with a bunch of examples. So Marriott here, we had we have three major simple moving averages on our daily chart. The blue is 20, green 50, red 200, so it shows short, intermediate term, and long term. So you can see here we had a bounce in a flat 200 MA. The 20 MA started to roll over. These are just visual aids. We do not trade off moving averages. But it had a bearish gap down to support, following a breakout failure and a rally and reversal. So the tell on this one was the bearish range expansion engulfing bar that made a closing new low. So we shorted the stock here, and this is a closing trade in our open and close spread sheet for all of our members and members area, and then I'll show you a couple Telegram alerts where we give new trades and trade adjustments while the trade is being managed until closure. And we just managed into weakness here, covered half or a third pre-market at 152, trailed a stop, had a beautiful gain on Marriott. Transports, the IYT ETF, big run, price void. What a price void is, it had such a big momentum move that there's insignificant support to the left. So here's another breakout failure at the 200 period moving average after a monster move here from under 210 to 250. Then it had closing, it was green bar ignored, then red bar. That would have been an ideal place to short also. But this one, here's our tell again. It had a 3 green bar to the gap fill and a wide range igniting with a big price void. So we shorted that stock and just went into trail mode. We had a beautiful gain on that. TRU, nasty gap, showing relative weakness to the sector. It tried to get its sea legs back, down, up, converging 20 and 50 period moving average, closing breakdown, shorted the stock. There's a technical reason, covered half over whatever it was here, and we made 8% return in 4 days shorting that. Now we also trade options when we have a compelling directional setup, and we buy calls if they're bullish, puts if they're bearish. We have different combination of debit spreads and diagonal spreads and so forth, but we'll keep it simple here. So here's another bearish gap, declining 20 and 50, went sideways for 1, 2, 3, 4, 5, but there's nothing to do here. It's going sideways for 4 bars. Now it gapped down in a closing breakdown. That is my bearish tell. So we bought puts. Actually, I'm showing the arrow here. So we actually didn't, we should have done it on this bar, but I guess I didn't see it. We bought the puts here, $4.30 a share. The pattern is continuation breakdown. You can see the history here, and we made 58% in a nice, beautiful 4-day swing trade there. Now here's an example where we not only bought puts, but we did a bear put debit spread. And all that means is we're buying one put, selling a further out of the money put, and that reduces the cost of our position. Now the disadvantage is we kept our upside, but it improves the probability of profit of the trade. So here, pull back. This is what we call a bear 180 reversal. This green bar should have gone higher. But you can see it made a lower high, lower low, and followed by a 180 reversal. That is our tell. Price void, the sector was weak. We made 46%. And when these things say 2 days, it's really 3 days. I gotta fix that because it's not counting the day that we entered. So 3 days, 46% return. So now I'm gonna show you why we sell credit spreads. Stocks can only do one of 3 things: uptrend, downtrend, sideways trend. So we find these patterns. I've just shown you a bunch of them. Every single directional trade is a candidate to sell a credit spread for income. And then if we're selling bullish put spreads on bullish patterns or bullish reversals, then we're selling out of the money puts or put spreads under support. As long as it expires above the short strike, we keep the money as pure profit. In these examples, since we nailed the bearish turn in the market, we're going to sell a bear call credit spread, which I'll show you in the examples. We're going to sell a call over resistance by a further out of the money call to make it a defined risk trade, credit spread. And then we're going to profit if the stock continues down, if it bobbles around sideways, and it can even go up a little bit against us. As long as it doesn't go above our calculated break even, we make money on the trade. So it gives us an edge where the stock can go against us and we still make money. We find these trades every single day. It's like an insurance company. We're getting paid these premiums over and over and over again. And sure, we have some stop outs. That's the equity curve. As long as it stays uptrending, you collect a lot of money. You manage them with the charts using our approach to minimize any drawdown. Here's the spiders when we got a bearish bias on the bearish reversal, and these are bearish continuation patterns. So once this bar closed like this, we sold an out of the money bear call credit spread. $5 wide, took in 55 cents a share, and I said you can add at 95 if we got a bounce, because this was a big wide range bar and it could have easily bounced. It didn't, but it could have. And here's the technical setup: bear, wide range bar engulfing reversal at the 20 MA, a bearish turn on the markets. If you sold 10 contracts of these, $550 would immediately be deposited into your account. It is yours to keep, as long as you don't mind selling 1,000 shares of spiders at $420 on or before expiration if the call buyer wants you to. We don't do them with that intent in mind. We do it as technical analysts saying, this thing's not going above here by the September 2nd expiration. And then we just manage as the stock moves in our intended favor to limit the any loss and to capture the majority of the potential max gain. Here's another one. I'll go through these quickly because they were all over the place. This is the Qs. We did them the same day, same pattern, same management. Here's Hilton Hotel. Had the bearish gap down, rallied up in resistance, and we shorted out of the money bear call credit. But this one, the 140s were way the heck up here. So if you understand chart analysis the way we do, the way we teach it, based on this bar, the odds of this going up in reversing this ugly red bar to close above 140 by expiration is very low. So and you can see we manage and take partial profits into weakness. Boeing here, big topping pattern. It wasn't a nice little uptrend here. Breakout failure, new low, new pivot low, lower high, green bar ignored, topping tail, engulfing bar, boom, that is our tell. This bar we entered is our tell, saying it's not going back above 172 strike by September 9 expiration. And then you can see how we manage it. With the gap down, let's close in the weakness, take the money. This is what we call a master trader sell setup. United Airlines rallied up, reversed at resistance in the 20. Wide range igniting, sell a call spread over these highs. It was a great trading week. These were all over the place, so I hope you're learning both a quick lesson of our patterns, how to trade topping patterns, breakdowns, and how to trade stocks and options around them using the master trader method. Wide range closing bar after breakout failure, topping pattern. We sold the 555, $10 wide, 75 cents, 10 contracts, $750 goes right into your account. We closed half at 25, half at 5. That gives us an average out of 15 cents. So we made 80% of our max gain on that. And that's another example. Come check us out in the Master Trader Live Green Trading Room, my partner Greg Capper and me. Instead of looking at beautiful little slides like I prepared for you, you will see us locate these trades and place them in real time. We will show you the why and the how, and it's a very educational room, answering questions all day, scanning. We're very active at the market open, trading gaps, our focus list, managing opens together. It's a great learning experience, and we have a great time also. Hope you enjoyed that. Any questions, email me, dan@mastertrader.com, and we will see you in the next weekly trade review video.